like if we're all just investing in picks and shovels, nobody's ever going to find gold. And I really would like to see the venture industry specifically move more towards the application layer. And I think that's where it's going. Time was whoever had the most technical investors would probably be the best venture firm in crypto. That's what drove outperformance. But I think you're moving in a fundamentally different direction. You have to play more at the app layer. And, funding all L1s right now feels like you're kind of fighting the last war, which is just going to be increasingly less relevant.
All right, welcome back, everyone, to the first official roundup of Bell Curve. I'm joined by Mike's 1 and 2. We'll see who's who by the end of the show. We got Yano and Vance. Fellas, welcome.
Macro Mike, Micro Mike, thanks for kicking it off.
Happy to be here.
We're cutting that. That is just not how we're going to start this podcast. Yeah. Speaking of micro, by the way, we're going to chop all the other stories that we all want to talk about. There's one big story that we got to talk about this week, right? That's the Vitalik. That's the Vitalik.
No, I thought you were going to naturally go. Speaking of micro strategy, Michael Saylor.
No, dude, I'm one step ahead of you. I'm one step ahead of you, dude. All right, I got some good memes saved for the end. Don't worry. All right, but let's actually get into it here because we got limited time. So Vance and Michael begged to talk about macro this week, so that's where we're actually going to start. With this chart here. So we're looking at the DXY, right, which is the index of the dollar, and then we're looking at the NASDAQ and Bitcoin. So basically, I don't want to rehash too much, but there was, the Fed had their Jackson Hole presser basically last week on Friday, and that's right around here. So I mean, they came out much more hawkish, right? There was a lot of debate about if he was going to accede or if he was basically he's going to be Arthur Burns or Volcker. And he kind of went Volcker and said, hey, we're going to raise rates to whatever we need to do. So the dollar has basically broached a 20-year high. And we've seen Bitcoin and the NASDAQ basically sell off in tandem. And, we don't need to really opine and try to read the tea leaves of the Fed, but I would be curious because there was a lot of talk about, is the merge in the driver's seat, fundamentals of the merge based around Ethereum, or is macro and rates really sitting in the driver's seat here? And I would guess based on just looking at this chart, they're like perfect inverses of each other. So I guess anything that jumps out to you guys looking at this chart.
Looking at this chart, things don't really jump off the page to me. Like if you do look at like the larger, if you click on all and look at kind of like the past 20 years, like this does become like a really crazy chart that just click on all. Yeah, like go way back. It's like it's really not been in this level for almost 22, 23 years.
Yeah.
And I was actually just thinking about this in the gym today, like all the inflation people are experiencing, especially in emerging markets, is just so much worse because the dollar is strengthening relative to their local currency. And it's so much better in the US as a result of the converse. There's an interesting theory called dollar milkshake theory, which is basically, the dollar is this wrecking ball. And when it goes up, it tends to break things. And when it goes down, it's kind of this rising tide that lifts all boats in the same way that interest rates work. And those are both highly correlated. But the strength in the dollar, the strength in the 10-year leads me to believe that macro is probably still in the driver's seat. But, the stock market today, at least, and this is, Thursday, September 1st, seems to be dropping potentially on its way to more weakness. But there's been relative strength in crypto, which has been really interesting to see. And I think kind of what you're finding out is like at some level, there is a crypto native bid for these assets that isn't really that affected or correlated to macro. So, I don't think I have like a super unique perspective on macro. This is certainly not what I'm kind of best at or paid to do, but it's, it's relevant because a lot of the world is just like one big trade. Are you easing? Are you loosening? Are you tightening? Are you pausing? So yeah, it's all correlated.
The one thing that I'd add is just to keep in mind that markets move so much faster than policy, and then policy moves faster than economics. So policy is going to happen before the numbers in CPI or GDP come through, and markets are going to move way faster than policy will. And the Fed, the president of, I think it's the Minneapolis Fed, Neil Kachikari, went on Odd Lots earlier this week and said he was happy with the reaction that the markets had to what was announced and what was talked about on Friday. And that, type of hawkish perspective from someone who coined the term inflation is transitory means that, we're probably going to see more stuff happen with Fed policy, and they're going to probably over hike before we actually see, a real turning of the policy perspective. But, and I saw this on Twitter last night, but right now, the market is predicting that we hit 4% interest rates in March 2023. And that's currently priced into the market. And so if you think that interest rates are going higher than 4% by March 2023, that would be a change in policy from what is already expected to happen. And so markets are already pricing this in. And I wouldn't be surprised if basically we see a change in perspective or a change in policy, or even a change in the way that it's being talked about. And that actually has positive impact on the market.
Maybe let's zoom in to our little corner of the world here. I mean, we've got basically a chart of major L1s, right? So we've got Cosmos, Ethereum, Polkadot, Bitcoin, Solana, and Avalanche. So, I mean, actually decently wide dispersion, I would say. But like the big outliers here are Cosmos, outperforming, especially over the course of the last month or so. And we've got Avalanche. We've got Avalanche maybe underperforming a little bit. I don't know where you guys want to start on either one of those two. Maybe we could start on Avalanche, since that's kind of the big news of the week. Maybe Michael, I'll tee you up for that one there.
I definitely, we can save a little bit of extra time for Avalanche conversations. I think it's hard to look at individual prices and perspectives on what that means. But I think the one thing that is really interesting here is just like ETH versus everything else. The alt layer one base layer perspective, it seems like kind of across the board, other than obviously Atom based on the price chart you're showing. But basically all the other alt layer ones are having a tougher time than Ethereum is price wise. But I think that obviously has some impact from the merge, but also just like generally, you're starting to see more gravitation towards at least layer twos onto Ethereum, and that also has an impact on Ethereum.
Mean, the other thing that stands out to me with this chart is if you think about something like ETH that's been, it was an ICO, I think at like 40 cents, and then it went to, $1,400 in 2017, and then it went down to $86, and then it went back to $4,900, and now back to $1,600. Like, there's been so much price discovery in that asset that one of the things that we're willing to pay a premium for assets like ETH that have just more price discovery is just the certainty that in a bear market, when things get crazy, what level of conviction do the holders of that asset actually have, or are we going to get sold into in these kind of like long drawn out bear markets? And if you think about kind of the various assets, Bitcoin, you have the forced sellers of miners when, the electricity cost to produce a Bitcoin is roughly equal to the market price of Bitcoin today. But then all these other all L1s, you have just like this structural selling of people that are unlocking tokens, which are a considerable percentage of a lot of their fully diluted valuations. So the things that surprise me, like AVAX on this chart is not super surprising given the lawsuit and probably people who knew about that before it really dropped. But Sol is kind of the one that stands out, where you just have this massive unlocking cycle that to me looks a lot like ETH did in 2017 or 2018, where it's just like everybody selling it all at once, relative weakness on the asset that used to be the strongest. And so it just goes to show you kind of that velocity and that acceleration that happens in the bear market. It works both ways.
Yeah, I would tend to agree with you. I mean, it's been an interesting last month for Cosmos. They've attracted some pretty interesting projects. So DYDX, right, is launching their own chain over there. And then Mike, I know you wanted to chat about Say, which is a new layer one. It's kind of specialized for DeFi. We can get into that because there's some pretty interesting implications for central limit order books there. But yeah, I kind of have the same take. I mean, I do want to get your guys' perspective on AVAX. So to set the scene, I was trying to load this picture, but I mean, you can see, we'll loop it in later, but like, CZ basically tweeted this out, but there was a website, you guys can all find this online, but that tweeted out kind of these explosive allegations where they had a lawyer on video, right, Kyle Roche, that was basically detailing, in his words, how Avalanche employed him as an early employee, gave him a whole bunch of equity to basically, to paraphrase, direct the ire of the CFTC and the SEC at other projects, to benefit Avalanche relatively to them. And I guess the caveats that I would say is, if you look at some of the other reporting that this website did, it didn't look super fair and unbiased. I would say there's definitely a perspective, kind of a pro ICP Definity type perspective. But I mean, the videos are the videos too, so it didn't look great. I don't know if you guys had a specific take, but CZ basically tweeted this out, and AVAX dropped like 10% basically as soon as he tweeted it. But I don't know if you guys had any specific thoughts or anything that you wanted to share.
First thing that comes to mind is like whenever people try to do like the fancy footwork, sneaky moves in crypto, like it rarely ever pans out in their favor over the long term. Yeah. Like, we have so many different anecdotes of like people trying stuff that they probably shouldn't have for like, trying to get back at competitors or things like that. It always kind of blows up in their face. And this is an area where, people are experimenting with software engineering, with financial engineering. The regulations have yet to have be defined. And people can get really hurt if you, are actively suing them, if you're actively directing regulatory agencies towards them. And so generally, it's just not a cool thing to do. Like, we should all be in this as Web3 stewards and stewards of this new movement. And this feels very PvP. And, the things that don't engender you to open source builders are things like this, where you're the gatekeeper, where you're the arbitrator of right versus wrong, where you're doing things that are vindictive. And so, yeah, I mean, I don't think that this will be the last that we hear of this. Regulators find out about things in a lot of the same ways that we do. They read things on the internet. They look at headlines on the Wall Street Journal, on various websites. So they're going to see this. And yeah, I mean, for all of the denials that Amin issued, the videos are just awful. And they point to a pretty black and white case, and we'll see what happens with it. But yeah, I mean, we shouldn't be encouraging this type of stuff, and we shouldn't just be, taking these denials at face value.
So one of the things that I kind of want to double click on and totally agree with what Van said. I mean, we should self-regulate our way out of this. But I think that's kind of the only stance that we can take at this point. And I feel like the industry has actually been doing a pretty good job of this so far. Like, we've gotten rid of, some pretty tasty characters over the last few months. And I think,
it's quite a list. It's quite a list.
But I think, it really is. Like, the hit list is huge. And I think, why do you think that is, I guess, is kind of the question that I'm asking. And my visceral reaction to my own question is, you're dealing with basically religious perspectives because there's money involved. And like, if this was just like open source technology and it was like one platform versus another, or like one company versus another, I feel like it would be less just painful, or less like dogmatic. But because it is involving money, I feel like that's something different. And it kind of goes back to and I know we're going to talk about it later, but like Rune's perspective of like the door is closed. And like we've like already lost in a lot of ways. And we can debate that later on in this conversation, but he's like, yeah, basically we have financial incentives here, and like we just continue to blow ourselves up because of human greed.
I think I take a different approach actually on this whole Avalanche case. This is not specific to crypto. Like, this is something that's been happening since the dawn of time. And like, you look at, I had a bunch of friends, probably similar to you guys, because you guys were like product people in San Francisco back in the day, who were at Uber and Lyft, right? And like, Uber had Operation Slog, where they would literally, in like 14 or 15 or 16 in the early days, where they would literally have Uber people who would get credit cards funded by Uber, and then they'd create fake Lyft accounts as drivers, as riders, and then they'd order Lyfts, and then they would basically no-show the Lyft drivers. So the Lyft drivers would get all pissed off with Lyft, and then they'd go back and start using Uber. So like, there are these backdoor things, and like even like Rockefeller, right? Like back in the days of like Standard Oils, like so that the regulators didn't come after him, he would basically direct the regulators and be like, here's something that my competitor is doing that's really, really slimy. And this is like, it's shady. It's not right, but like it's not specific to crypto. It's something that's been happening at the like highest levels of business, I would say, forever.
I just felt like I was watching dirty laundry get aired. I just don't think like anyone, it's kind of like when you watch like a a boyfriend and a girlfriend like get really hammered and then like fight at a party, and you're like, I don't even know whose side I'm on. I just want this to stop. Like, please, for the love of God. I just don't like what I'm seeing here. I didn't, because like some of it didn't stand up to me. Like some of it, this guy, like what I didn't believe the way he was portraying it. It was like he's the one, the marionette, like pulling the strings at the SEC and CFTC. I was like, I don't buy that. I don't think that's how that works, So like that wasn't really standing up to me, but like I didn't love the response from it was just a weird
I also
thing.
I just don't trust this. Whatever. I just don't.
Very suspect.
I just don't. That's very suspect. Whatever I'm looking at. So just got to flag that.
One of the interesting angles here is he's been removed as one of the lawyers on a number of different cases that are currently ongoing. The tentacles run deep for Kyle, which is kind of funny.
Kyle. All right, well, let's move. I kind of think it's a dirty laundry. If it is true, then it's obviously goes without saying it's just a super uncool move and just not becoming for, because I think one of the things that might be different, like even Mark Benioff, right? Like he did all this crazy stuff with the media, right? When he was building Salesforce, but it's a little bit different in crypto. We're still so early stage, and there's a huge focus on community that there might not have been for other. Like I didn't get the
bullshit.
I didn't.
Bullshit.
You don't agree? I don't get the feeling that Rockefeller was like, "Let me build a community around this oil company."
No. Okay, let's use like you said Salesforce. Benioff. Like at the beginning, there was no SaaS industry. There used to be no SaaS industry until Salesforce. Salesforce would literally hire protesters, like fake protesters, and they would go protest outside of like Oracle conferences and stuff. And he'd hire hundreds of people, and they were protesters, but really they were just paid for by Benioff. Like this is just, I don't know. It's just, I'm not for it. I'm just saying this is like
this is how the sausage gets made.
Yeah.
I do
now
think
you're getting some direct insight into Blockworks' line item OPEX spend.
I think I don't think last cycle we did a good job of being self-regulating. Like we didn't call out things, or at least when people did, it was just drowned out in a sea of people just making money. And so I don't know if I'm certainly not in favor of like cancel culture or like, taking Kyle out of a job forever. No. But we should be trying to keep each other honest at a bare minimum. Yeah, that feels like an okay goal.
I agree with that. All right, I'm going to start sharing my screen again. I actually, I want to get into this topic of value accrual because we're going to move on to talk about L2s and specifically Nitro's launch on Arbitrum and some of the activity that's going on there. But I want you guys to guess, if you guys had to guess some of the DeFi majors like Compound, Aave, Uniswap, let's say, last 2 years of performance relative to ETH, how do you think they did?
Say probably down 50% or 60%, maybe more. Oh, last 2 years?
Since this, last 2 years.
Let's say since October 2022, so almost 2 years. October 2020.
Wait, since October 2020, yeah.
Down pretty. Well, what's the price? I would say down probably 50%.
I think October 2020 is a bad time.
Yeah, because that was post DeFi summer. That'd be a tough benchmark to hit. I'm going to say up.
Wow, we got pretty big spread so far. We got -50 and up. Up what?
I'd say even, because I think ETH was pretty high back then, if I recall, but I could be off.
Yeah, no.
I think it's round. I mean, haven't both of them round tripped since October 2020? Essentially, no. I think DeFi's down. I think like Aave and Comp and Uni are down relative to ETH. I think ETH was at like 300 or 400 or $500. It's at like what 1,500 today. Aave's probably down.
All right, make your guess because I shared my screen too quickly.
It's down. DeFi's down. DeFi's down relative to ETH.
These are the numbers here. It's like not great. It's not great. So if you're not following, so Aave is the leader. It's down about 52%. Then it's Uniswap at 67, Maker down 70, Curve 71, Comp is down 91.86%. It's not great.
Comp is down 91% relative to ETH.
Yeah, the reason I picked this is it's 2 years. It's about even, and this is as far back as it goes on TradingView. So it's the easiest way that I can do it. But if you go back and so that's my scientific method. But if you go back, you can look at CoinGecko and just look at like charts of like Maker denominated in ETH. You go all the way back to 2018 or whatever they launched, and it's like a straight I mean, it's a straight. I mean, what the reason this got flagged is, I saw it on Twitter. Maker denominating ETH is like almost the lowest it's ever been, basically. So basically, DeFi as a sector has kind of bottomed out. I think it kind of raises larger questions about value accrual, and it also, I mean, we're going to talk about Say as well, but why it's still such a good bet to bet on L1s. I would be curious. I'd be interested to see if this same pattern holds up with like Solana and some of the dApps that are built on there. I have no idea.
I don't think the L1 trade is there anymore, actually. I know. So I think what happened is the L1 trade happened in like the last bull cycle was like the L1 cycle kicked everything, or it was like DeFi summer, and then everything rotated into these L1s, and like Solana ripped, and then Avalanche. And I think what's happening now is you have all these like the Aptoses and Suis. Like there's going to be like 40 L1s going into the next cycle, and I think there's going to be people chasing the L1 trade, but the L1 trade is going to get, instead of getting spread out over like near Solana Avalanche, it's going to get spread out over like 40 different L1s, and the trade won't be as intense.
Well, but I actually disagree to a certain extent, because I actually think that if you look at anything in crypto right now, where is the most value aggregating? And this is to Mike's point, it's aggregating in the L1s. And if you're raising $5 million for probably, I don't know, let's say like 5, 10, 15% of the tokens, it's a pretty good bet to make to be able to buy that.
But what L1 raises $5 million right now?
That's what Say raised. Yeah.
I don't know much about Say. I don't know.
Say's pretty interesting. I don't know. Maybe we should, I'm jumping around a little bit, but maybe we should talk about that. Cause I feel like the reason why that might be worth bringing up is it made a pretty interesting trade-off, especially when it comes to like, there's a big debate, right? Central limit order book versus AMMs in general. But just to give you guys kind of like the rundown for what happened. So this is a new L1. They raised $5 million. It's an L1 blockchain that's optimized for DeFi. So it's not an app specific chain, and it's not a generalized L1 blockchain. It's kind of this mix in between. So it raised 5 million in funding. It was led by Multicoin with participation, round robin of, kind of blue chips like Coinbase Ventures, Delphi Digital, Hudson River Trading, GSR, et cetera. Basically, I mean, in their words here, so most L1s fall into like a barbell type distribution. You've got two extremes. So the general purpose chains, and that's like ETH and Solana. Then you've got app specific chains like what DYDX is trying to do. And you've also got Osmosis in the Cosmos ecosystem. And basically the way I understand it, the limitation is in a general purpose blockchain like Solana, even if you have low fees, if it's a successful blockchain at all, it attracts a whole bunch of other activity outside of just DeFi, right? So maybe on Solana, it was like the NFTs. When you have that congestion in the block space, fees go up, and that naturally disrupts some of the, basically the DeFi type purposes. And so then you have kind of like these app specific chains, which is what DYDX is trying to do on Cosmos. But then Say takes a little bit of an in between, where it's actually a not totally general purpose L1. They've got like a built-in order matching engine, but actually they're trying to encourage they're trying to make it very easy to spin up central limit order book markets on that chain, right? So it's not like you go to Say exchange. They're trying to make it very easy for you to spin up separate markets. I'm
sorry, why is this not, you might have just explained it, but middle of the bell curve here, why is this not Solana? What Solana tried to do?
Michael's like, it is, baby. It is Solana.
I'm just going to call it how I see it, which is like, this feels like Multicoin taking another shot on goal. This was their blog post for the Solana investment. Like, you can build central limit order books and like spot and derivatives trading on, you can't do all that stuff on chain now, but you can do it on chain if you can build something that looks like Solana. And now it's 2 years later, and I'm down with Say, I'm down with more L1s. I just feel like we should say what it is, which is Multicoin taking another shot on goal.
Yeah, I mean, don't want to dog Kyle or Tushar for it. We like those guys.
No, I don't think it's a bad thing, by the way. I'm not like for it. I'm not against it. I'm mostly just like, who cares? Like, we've been around long enough, and we see literally like 2,000-3,000 pitches per year. Most of them are not L1s, but like a good chunk of them are. And some of them are L2s, and some of them are variations. And like, we've literally heard everything: parachains, app chains, scales via hardware, scales via L2, scales via subnets. It's written in JavaScript, whatever. Like, who cares? Who's actually going to use this thing? How is it going to get distribution? And, the reason why we
are so interested in things like ETH and Bitcoin to a lesser extent is because they have not only this technology angle, but they have the call option of being money. And that is like the fundamentally mispriced option, which is, that's how these assets get to trillions and trillions and trillions of dollars of scale. And, there's this concept of like the window. Okay. A year ago, a year and a half ago, ETH fees were high. The scaling roadmap was far away. The alt L1s were hot on their tail. Like the window was wide open. Flash forward to today, most of the transaction fees on these L2s are 10 cents. And it's, really easy to build your own L2 sidechain that transitions into an L2. Like, why would you not just do that, all things considered? And I think the answer is basically, well, the incentives are to become your own L1 because that's like where the highest market cap could be. But that window, in our opinion, is basically closed. Like if 4844 gets put in, and that's basically this improvement proposal, which lowers the cost of putting call data on chain, like what's the point of doing this other stuff? And like, it's not like, funding round gets announced, 3 months later, the blockchain's out, 6 months later, it's in mainnet. It's like the funding gets announced, a year later, it's like ready for alpha. A year later, it's got like tools. A year later, you got the community. It's like, that's way far in the future. Like if we're all just investing in picks and shovels, nobody's ever going to find gold. And I really would like to see the venture industry specifically move more towards the application layer. And I think that's where it's going. Time was whoever had the most technical investors would probably be the best venture firm in crypto. That's what drove outperformance. But I think you're moving in a fundamentally different direction. You have to play more at the app layer. And, funding all L1s right now feels like you're kind of fighting the last war, which is just going to be increasingly less relevant.
It's also just we can't have another cycle where we just fund L1s because we're going to have another cycle where like there's no, quote unquote adoption that comes. It's probably not good for your portfolio, but it's also really not good for the space to just keep funding these L1s.
The one caveat that I would give is there is this like intermediate time period right now where a lot of all L1s have been funded. There's all the different modular blockchain examples, but you're literally in a race against time for the scaling of other major blockchains, L1 smart contracts with L2s that have scaling to really scale. And that's what EIP 4844 does. I mean, Nitro just launched yesterday on Arbitrum, and we were talking about it, but like 6 cents is the transaction fee. With EIP 4844, that goes down to sub-cent layer. And once you have that, it's really going to be hard to compete with the security model of Ethereum, the community of Ethereum, and frankly, the apps and development and tooling that has already been happening on Ethereum for the last 6 years.
I know you guys are all in on ETH. Can I push you guys to take the other side of the argument?
Sure. The other side of the argument is, at least I would start with this. I would say the intervening year that's about to happen doesn't matter. It's going to be kind of like flat to bearish. There's not going to be any blockchains that hit like these hyper adoption moments. Like ETH's network effects are not likely to grow. And so, you would kind of draw a line from that to saying, all right, the network effects are relatively weak. We can easily replicate a DeFi ecosystem. NFTs are harder. Like you basically have to that's a function of time effectively building an NFT ecosystem. And maybe we can peel off like a few games. And if those games hit, instantly we have the biggest blockchain with the most amount of users. And, I think the thing that's most exciting about if I were the people who invested in it would probably be the valuation. It's a cheap call option on all of that happening. And at a certain price, it is priced right to happen. But, you have to think probabilistically as an investor. And that's why, this does make sense in some contexts, but yeah.
I'd also add that the major difference between something that you're constructing from the ground up now versus something that's been around since 2015 is frankly just tech debt. The amount of time and energy spent actually like trying to pull off a major change like the merge that is supposedly going to happen in the next 2 weeks is just orders of magnitude harder based on the stuff that you have to go through to get it to the point that it is now, with it also being live and at the scale that it is today and has been for the last few years. So there is a really strong argument to be made around like just being able to move faster because you don't have that. And so, yeah, I mean, that is a totally fair point.
The thing that is not available to people who make this argument anymore that used to be was like when Solana came out, it was like there's new types of applications that can be built on Solana that cannot be built on Ethereum. And that was like, you know, as people who hold ETH, like that was like, oh shit, like this could run away from us pretty quickly. But again, it comes back to that concept of the window. And the window for that type of differentiation is basically over. And so what is it now? That's a little bit harder of a question to answer now versus a year ago.
I guess my because Jason, go back all the way to what you said, like, is say just another Solana? I mean, the difference there is that Solana is a completely permissionless general purpose blockchain. So you have other applications that aren't necessarily DeFi, whereas Say is optimized for DeFi applications, right? So you don't get a lot of that clogging. They also have, I mean, they've built some pretty interesting stuff in there. Like they've kind of solved the front running issue of MEV, like the transactions per second that they have. It's something like 7,300 transactions per second versus DYDX is 500. So they've made some, you know, I think if I had to strongman the argument for that as well, I'd say like a lot of the unlocks, like, you know, how they come in cost reductions, you know, in other industries like biotech, like the cost of sequencing a genome went from like, I forget, some enormous amount. It took like multiple years and now you can do it for like $500. So that's a huge unlock. I think you know, if you optimize entirely for speed and you make some trade-offs, but you optimize for speed, then you get a whole bunch of unlocks that are hard to understand now. Like that's the whole business model behind high frequency trading is you have to order sorry, Michael, you look like you're going to say something. What's going on?
Well, I was going to ask the question though, like, yeah, right. Sequencing the genome is sequencing the genome. And if you have the ability to do that at an orders of magnitude lower cost, it's hugely valuable. Implicit in the question though, in this context is the question, does a central limit order book maintain its position as the most preferred way of trading? Or is it something like an AMM or frankly something new that hasn't existed yet, but is now enabled by a blockchain that is the dominant way that we trade for crypto? And I mean, look at the traditional financial industry. The dominant trading pattern is options, but think of options relative to perps when it comes to crypto. And we do have new models, new trading methodologies that are just different for this industry. So one of the questions that I kind of maybe pose to the entire group is like, is a central limit order book something that we're going to continue to have at the same volume that we've had in traditional markets?
It's hard for me to answer that. Apparently, like the volume of like high frequency traders versus, you know, regular organic flow is something like 25 times to 1 or something like that. So the business model of exchanges basically exists around, you know, it's a central limit order book they cater to, and they allow those high frequency traders like to basically trade more cheaply in exchange for providing liquidity. I don't know if that's the only model, but I think you need to come up with something like liquidity is good for markets in general. So I think if you're going to say, all right, we don't need to do it with a central limit order book anymore. Instead, it's going to be maybe concentrated liquidity on the AMM space. Like Uni V3 is pretty interesting, frankly. But I think you need to come up with something that replaces that. Is the only thing I say. But I'm not, you know, bell curve guy. I'm not sure what that is exactly.
The two questions that I like ask when you ask that question to me are basically like, what's the differentiated functionality of an AMM versus an order book? And I think like AMMs have great product market fit for the long tail of assets. Like you can spin it up, especially Uni V2, provide liquidity, you know, Bob's your uncle, like it's trading, it's live, it's whatever. Like that's a great use case that literally is not available for central limit order books. And for the things that have a little bit more scale, like Uni V3, it's challenging to be an LP there. We've done a lot of analysis, which suggests like you're basically break even in permanent loss versus fees, if not negative. But like that's a great way that you can do sizable block trades in the same way as a central limit order book and get about the same execution. And then I think about like, okay, is it better on price? And AMMs are, you know, probably not quite as good on price, but looking back at the historicals, like everything that we know about crypto and retail interacting with crypto would suggest that they are very fee insensitive. That is not the thing that matters the most to them. You know, they're willing to pay 2% for NFTs. So, you know, at the highest level of scale, at like the Binance level where you're doing like tens or, you know, hundreds of billions of dollars of volume, you know, per day, per month, whatever, you probably do need a central limit order book as that anchor. But like for the rest of the ecosystem, to me, it's like, who cares? Like Serum is great, but like, who cares? Like, who uses it? You know, do people want to use the Orca DEX instead? Like all of the Steppen people do, you know? Who knows?
If I had to,
why do they use Orca?
That's a good question. I don't know.
Well, yeah.
What's up, Yana?
Well, because they're Steppen people and they rebranded right?
Oh yeah, I think they might have started their own decks too. So maybe that's no longer the case.
If I know I was kind of ragging on Say, and we can move on from Say in a second, but like if this was a non-crypto company, I actually probably might like it, because I'm going to try to play devil's advocate to what I'm saying, which is and try to take the other side of the argument. If there was like a cloud provider that came into the market and they were like, all right, we're going to go head to head with Google, Amazon, and Microsoft. I was like, great. Who are your early customers you're going to target? Who are you going after? And they're like, oh, everyone. SaaS companies, gaming, finance. I'd be like, all right, well, there's no way you're winning. You have no chance. And I think what Say is doing is they're like, all that other stuff, like other people can go win it, but like NFTs, like go do that somewhere else. And honestly, like it's probably pretty smart. Like a poorly designed NFT mint can consume all the block space and kind of ruin DeFi for a couple of days on a blockchain. And so, yeah, that's probably the counter argument, is like hyper-focused companies and founders usually do win.
That's true. I'm also very bullish on poorly designed NFT mints because they just burn a lot of it. So
burn, baby, burn.
Incentives, baby.
All right, let's move on because I had this up here and we weren't even looking at it. But I want to get your guys' take on Arbitrum, maybe in relation to optimism as well. So Nitro got rolled out, which is basically an enormous improvement. I guess actually we should start with Odyssey, I think was a pretty interesting initiative that was rolled out by Arbitrum. It was basically, like, to paraphrase, it was essentially a scavenger hunt that Arbitrum was trying to put its users through. Say, hey, like there are going to be these 56, the top apps that are going to be grouped in this thing, and if you should go like use all of these different things, right? Like decentralized exchanges and whatever. And you essentially have the ability to earn these NFTs. So this was rolled out in June. It was live for about a week. Then they had to pause it because the fees that to transact on Optimism or on Arbitrum were actually higher than Ethereum. So they had this big announcement, we're going to pause. And you can actually see it. I'll share my screen again in the spikes on this chart. But they paused Odyssey, and what they just rolled out Nitro, which is an enormous increase in terms of transaction throughput. So it's like 6 to 10 times, increased it by almost a full order of magnitude. And it looks like, they've kind of moved in lockstep here, but it looks like they're starting to win, right? So transactions per day is flipped, transacting addresses per day is flipped between Arbitrum and Optimism. I'm curious if you guys have, and some of the projects as well, like GMX is kind of the standout, right, on Arbitrum. I'm curious if you guys have any thoughts on just Arbitrum versus Optimism in general, or just, I guess, the Arbitrum ecosystem.
I will just say, like, Vance and Michael are going to have much better takes on this than I do. But like, I think when you look at these charts today, in 2 years, when you look, like you're saying, like, oh, the transactions flipped. When you look at these charts in 2 years, these are going to be like the smallest little blips on the chart. So like, I actually don't, Optimism will probably flip back and overtake Arbitrum at some point. Then it'll flip back, then it'll flip back. And these will just be like, we're at 0.0001% of the transactions that will end up happening on L2. So like, I know what you're getting at. I just wouldn't spend too much time on this. Yeah.
Yes. That was literally going to be my first reaction. Is it feels like we zoomed into like the 2013 bubble and crash on the price chart, and it'd be nice to zoom out a couple of years and be able to see where we actually are. I mean, we were talking about it earlier, but EIP 14844 is going to be something that 10 to 100x is the amount of cost, or decreases the amount of cost for call data on L1. Assuming that goes in, assuming it works the way that it is supposed to work. This stuff here is kind of moot, but I also agree. I think this is just going to be a dogfight, and you can literally see it in the transaction fees or the transacting addresses. It's just going to bounce back and forth. The thing that will be the difference maker, though, is where applications aggregate. So you've got certain applications that are Optimism only. You've got others that are Arbitrum only. Do you have the ability to have cross Arbitrum Optimism and have that be a seamless experience? If that's the case, it's going to be really who's who. The other angle that I think is really interesting as well is there going to be a centralized bridge to be able to get from L1 to L2? Right now, if you pull your assets off of, and I don't know Arbitrum, I've done it personally recently on Optimism. Still takes 7 days. You're waiting 7 days to be able to pull assets off of Optimism. If you can have that be something that is, a centralized bridge, and there's just market makers that can arb that away and get you assets immediately, or you can trust the process, that is a great thing. But for 7 days, you're basically waiting for things to disappear and then come back. It's a weird feeling for a blockchain.
Do you guys like when we were looking at Gem versus Genie back in the day? I remember like all the Twitter peanut gallery was like, oh man, it's over. Like Gem is like way in the lead. Like they're blowing them out. And like, it looked that way if you pulled up Dune. But then if you dug into the amount of users, it was like, Gem had like 60 more users than Genie, and they had like 100 total combined. And so like, yeah, I mean, CT, to your point, Jason, kind of like tries to call everything early. I think my unique perspectives on this are the 7-day withdrawal window makes these things kind of like one-way bridges. Like getting your stuff off of these chains is very hard, and we've done it, but it kind of makes the nature of them one directional. And, it's just going to be this thing that sucks in a ton of users, and they don't really leave. And the way I think about ETH-L1 and the continuing value accrual there is like, number one, like DeFi and NFTs are extraordinarily sticky for ETH-L1 whales. And that's kind of like where, the 3 to 4K ETH fees per day are going to come from in the next 6 or 12 months. That's what we're guessing. But number two, now that we understand, at some sort of scale, what the cost dynamics for these, blockchains are, we can understand like what's valuable about this emerging kind of thesis of like the modular blockchain stack. And so if you look at, say Arbitrum transactions are $1 each, I'm paraphrasing Polina, who's a great Twitter follow if you don't follow him. About 55% are just like, paying for Arbitrum fees of that dollar. So 55 cents. About 40 cents are for paying for data availability and posting call data to L1. And then 1% is just paying for, or like a very small percentage of that dollar is actually for paying for settlement on L1. And so like you're actually starting to understand like what is valuable, what are people willing to pay for? Is it the settlement layer? Is it the data availability? Like what is it exactly? And that's very interesting to me, because I think like eventually we're going to have to come to some sort of consensus as to like, all right, what is the minimum that these L2s can pay these L1s and still claim like to be affiliated with the Ethereum community, to have this credible decentralization? Because you're always going to have this push and pull between people who are holding, Arbitrum or Optimism tokens, who wants the value of accrual to flow to that, versus the people who want to, continue paying relatively high amounts for settlement and data availability on the L1. So it's interesting to get this early kind of feedback on exactly what that value accrual dynamic is and could potentially be.
I think it's kind of interesting to look at. I mean, the big difference, point taken, we are zooming in on a really small period of time, but the big difference I would say right now in between, it's just like their acquisition strategy, because Optimism actually has a token and they're doling out incentives like left, right, and center, which is why you see those like enormous spikes. Whereas Arbitrum has kind of a different strategy where I guess the NFTs are an incentive as well. But really, I mean, the real reason why Odyssey was so popular was there was the idea of incentives in the future, like potential airdrops, right, of the Arbitrum token. Everyone's basically taking it as a given. So I do think it's kind of interesting just looking at, people are trying out new strategies, for like go to market for like how to migrate users from ETH to this L2 versus the other L2. It's kind of interesting.
I don't know why, but I just got really strong Rob Hanneman vibes.
Russ Hanneman.
A pre-revenue pure play.
Never get revenue.
Russ Hanneman, there we go.
Like this.
a pre-token pure
That's
play.
That's the dream.
Value of having a token, you can get 90% of that by just telling people like you're going to have one in the future, or we'll airdrop.
You will have
it's
one.
Like you don't,
Yeah.
you don't need to actually use it. You just need to tell people you have it.
So basically, you're like dangling the meat in front of the dog, basically.
Yeah.
Hoping that the dog jumps.
Yeah.
Honestly, I have heard that
it's like
subscribers of Bell Curve could get a token. So if you're listening, tap that little subscribe.
Nice. I mean, I think the biggest, like token aside, I think the biggest thing that we're going to see, and like summing up this whole L2 discussion, or frankly even just like execution discussion, where people are transacting or choosing to use the applications, it all comes down to price. And if you have lower prices, not only is it just easier to use, like obviously less expensive, but it opens the aperture lens of what applications actually can be built on these chains. And one of the interesting things that Vance and I talked about a lot in, I think it was like 2020, 2021, was basically, if you have a 10x decrease in fees, what do you think happens to the revenue that's flowing through, like price times quantity? It actually increases because you have more transactions at lower cost than you would, if you had higher costs. And so I think as we see these decreases of, 10x, like I think we saw with Nitro or whatever it is, 6x, you're going to see more activity aggregate there just because the fact
the other thing I would say,
it.
Going back to the say discussion, like what would be the counter argument to, being bearish? So you'd be bullish on say in this instance. I think one of them would be, yeah, cool. You fixed the scaling problem for the 20,000 users that are on Arbitrum and Optimism today. But like the second that you have a popular game with 10 million users, you're going to be right back in the bucket of like, okay, you didn't actually scale this. And like, that's kind of to Michael's point of like, if fees decrease, will people fill up that block space? Like the people we're opening up block space for are like game developers and like people who have millions and millions of users. And frankly, like we still have not tested that level of usage on any blockchain consistently, I would say. ETH is around 500K daily active users per day. Most of the major blockchains are half that, 2/3 of that.
All right, I want to move on to Maker. I think this is going to be kind of a meaty discussion, frankly. So Rune's been publishing like multiple different, I guess, iterations of his version of Endgame. And he just came out with a pretty recent post, but I guess to sum everything up, I mean, there was a lot of attention that got paid to the OFAC sanctions, the treasury sanctions, on different smart contract addresses. So Tornado Cash kind of got shut down. And then Rune in the Discord for Maker said something to the effect of maybe we should just YOLO into ETH and, disregard the peg, which he kind of walked back, but now is like kind of addressing more seriously and like laying out a very specific vision for what he thinks the end game is for Maker. So we'll link the whole thing in the show notes here, but basically to sum everything up from the TLDR that he posted, the title of the proposal is The Path of Compliance and Path of Decentralization, when Maker has no choice but to abandon the peg. He kind of describes it in like 3 different phases, right? So financial regulation has trended towards a post 9/11 paradigm, either of you're with us or you're against us, with the eventual zero tolerance for anything that doesn't give full, surveillance power essentially over, any sort of financial infrastructure in general. DeFi has kind of failed to prove real value and demonstrate real value to, let's say, the masses, right? So obviously we got some sort of negative PR, to put it lightly, with massive crashes around Terra and Celsius, even though Celsius wasn't DeFi. And I think, and actually Jason and I, we just did an interview with Kane, and he did say that a lot of even like the founder class in DeFi was like kind of taken aback. They didn't really expect this severe of a crackdown at this period of time. So I think the whole community is sort of reeling with what to do. And the big challenge for Maker is that DAI, it can't become blacklistable. So they basically Maker doesn't even have the option of being compliant. So, the solution that Rune is outlining here is to limit the attack service by limiting the amount of RWA, which is real world asset exposure, that they have. And he's kind of freely admitting that the likely outcome of this would be, in his exact words, to cause DAI to free float away from USD at stable, predictable rate that feels like negative interest rates. And basically this endgame plan that he's outlined has 2 effective tools to deal with this: MakerDAOs and protocol-owned Vault, which is crypto speak for balance sheet. There's like so much to unpack here. I actually tried to read the full thing and I felt like I was reading Chinese, like 45 minutes in. I was like, dude, is this the same language? What are your, I have opinions on this, especially because I think there's a fundamental misalignment at the top of what Maker even really is. But like, what's your guys'
that's what I was going to say, Mike.
Yeah.
Like, I think when you talk about the end, this is the second iteration, or like, honestly, like there have been many iterations of the end game. The end game didn't, like, now it's all about real world assets and like censorship and like free floating DAI. But really the end game plan started as just a conversation about like how to structure what MakerDAO really is. And like, you could use the word governance as like the all encompassing word, but it's really not that. Like right now, like Maker is just this hodgepodge of like core units that are just like, it's like very messy. If you look at the end game plan, like he uses this image of Google, or really Alphabet, right? Where it's like, okay, you have these, like what he's trying to in his words, he's like, I want to transform Maker from this like unclear structure into something where every aspect of Maker is very well documented, where people have like KPIs and goals. And like, if you look at Google, it's like Alphabet owns like Google X, Sidewalk Labs, Google Ventures, Fiber, Google Capital, Nest. Inside one of those is Google, and Google owns Android and Maps and Ads and Search and YouTube. And then within YouTube, you have like YouTube Kids, and then you have like the main YouTube. And like each team has very strong KPIs, and they have like a budget. And that's, I think, where all this came from, which makes sense. Like if you, again, like trying to not think about this in crypto speak and like RWAs and PSMs and DAI and like D3Ms, like if you just think about this is a founder being like, holy shit, my startup just went from 10 people to like 200 people. It's so chaotic. I'm trying to like wrangle this in. That's what I'm seeing, is a founder who's like, whoa, my startup just got really big. I need to think about organizational structure.
It's an interesting take. I mean, my like reading of the tea leaves, and I don't disagree with that, because I don't think that they're mutually exclusive. But my take here is just let's roll back the tape of what Maker is, which is the first DeFi protocol, and DAI is the first decentralized stablecoin to hit scale. Let's say it may not be the first, but it's the first one to hit scale. And where you got to real world assets, which felt like an about face for the entire direction of the protocol, was what happened following March 2020 crash, where you needed to find stability, you needed to find new asset collateral to be able to add to the ecosystem. And so that's where you had the first vote to add USDC as one of these collateral types that you could put into Maker, because you had to be able to have that to be able to stabilize DAI following the crash and the outage and everything that happened, during that period of time. And now you have a continuation of that strategy where you have, $100 million off-chain loan to the bank, and I can't remember the name, but that's another real-world asset that is the first of its kind. But also that happened very recently. It's not like that was something that happened a year ago, and now you have a complete additional about face back to the original thesis of let's be fully decentralized, fully on-chain. I think, as he described in the post, his hands are tied in a lot of ways. So it does make sense to move in this direction at this point. But it's been a lot of whipsawing back and forth. I think, maybe it's a realization of like this startup, this company that we're running, this organization is massive and need to have more structure to it. But it's also, it also just feels very unplanned.
Back in the day, Maker owned a exchange called Oasis that owned a broker-dealer license. Rune was going on CNBC as the CEO of Maker, in a collared shirt. I remember that DevCon Osaka speech, Michael, he gave when he was like, we're going to TradFi, all this stuff. And so it is like a really different perspective. And I think beyond like the direction that DAI goes, just for the record, like I very much disagree with Rune about like DeFi providing no value, the window being closed for these things to be regulated institutions, basically all of that stuff. Like we've only started engaging with regulators and legislators over the past year. And for the most part, there've been definitely some people who push back, but there's a lot of people who are in our corner. And I think we're just waiting for a time where, the stars are aligned with the right administration, with the right, balance of Congress to actually get something done. And Michael and I spent a lot of time helping push that forward. And so like, I don't think it's time to just like roll over and die and just be like, okay, it's only going to be, decentralized protocols from here on out. And like, we're all going to be anon devs. Like that's very much not the future that I see for this asset class. And Michael shares that as well. In terms of, the paths that these DeFi protocols take forward, like call it the OGs or whatever. I think one path is, going into the window that Rune says is now closed, or at least waiting for that window to reopen. And I think it's more of like a reopening concept where like, we're certainly not in the window where that can happen today. Like if Maker walked into the SEC and wanted to register with them, I just don't know how that would happen. But in the future, I think there is the potential for a legislative framework for that to very much be a possibility. But that's probably 2 or 3 years away. And so like if you're playing for that regulated window to open, you're playing for some date that's a little bit further in the future, and you need to be aligned with that. And, places like Uniswap, places that are also in the US that are in DeFi, like they're very much going down that path. And I think that will be a fruitful one. For the people who don't want to do that, who are probably more international in terms of their basis, in the countries they're located in, maybe there isn't a way to register. Maybe it doesn't even matter particularly. But I think a lot of the paths that they take, these international DeFi OG protocols, will be kind of like this fully crypto native version of what they're doing that's just reliant on the endogenous growth of crypto. Like if Maker gets a bunch of USDC in their vaults and they really own it and they start paying down the debt of the vault owners and ETH starts mooning, like that's going to be a very, very, very powerful protocol. And they have the potential to draw in a lot of ETH. And so like you're just betting on the endogenous growth of ETH and the desire for truly permissionless systems, which, is lumpy, but it's very important. The last kind of unique perspective I think I have on this is like, if you really dig into the economics and the mechanisms of how this proposal works, it's kind of like a DeFi summer style playbook. It's like, yep, we're going to depeg. We're going to like get a bunch of money in the vaults. We're going to go off and yield farm with it. We're going to go pay off people's debts with that. It's like, okay, like this is kind of like almost like Alchemex in a way. And I think that's cool. And I think it's definitely a departure from like the Maker that we know, where it's like Rune in a collared shirt on CNBC, Maker kind of just like not doing anything for like a year, 2 years. Like if you play back the tape on DeFi Summer last time, they missed that. Like they were not a part of that cohort. And so, yeah, I mean, at the end of the day, it comes down to what does your team want to do and what are they good at? And for a loosely affiliated group of contributors that are not based in the US that want to run this like crypto anarchist playbook, it seems like kind of only the only direction you can go in time. Like Rune at the beginning of his post says that like the earliest this could happen is 3 years. So this is them getting kind of, in their, ready, set, go stance. But yeah, I think it's an awesome discussion and it leaves a lot for other DeFi founders to consider.
I agree with parts of that. I think the one thing that I would say is like the product in my vision of Maker is something that is supposed to be $1, right? You're supposed to look at this and be like, everything that Maker is doing is in service of creating something that is $1 and it is at least of stable value. So it kind of like as me, if let me, because I do think it's cool to experiment with new economic models and like, hey, could we like yield farm some of this and give rewards back? But the way that I would think about it, if I had to denominate my entire life in Maker, all these assets that I have, all my wealth is denominated in DAI now instead of US dollars. I would kind of have the perspective of like, yeah, back that shit up with something real, probably back that up. Probably don't do any of that stuff. Actually, probably just put dollars in there. And I'm not saying that because I see the problem with the real world asset as well. Actually, Jason, maybe to carry your analogy of being a founder a little bit further, if I was Rune, I think I'm not Rune, obviously, but I guess if I was sitting in his seat and I like deeply believed in the ethos that I believe that he has, right, which is trying to create a decentralized stablecoin that's separate from real world assets, but then you're also like, he ran up against the limits of where he was in time, right, which was that there wasn't enough demand to mint DAI against ETH. So he had to, in order to grow the protocol and have it survive, he needed to find other collateral, another source of collateral. And it's like, this is where my ideology and what I want to build runs up. The rubber meets the road in terms of what options I have as a founder and what I have to do. And I kind of think that he made the only choice that he could at that moment in time. And this is like where like a butterfly flaps its wings. And maybe if he had been doing it 5 years later and there was more solid collateral, like ETH was an order of magnitude larger, even Bitcoin or other crypto assets, he had more options, then he could have taken a different path. But I kind of,
I don't think Rune wants to depeg. I don't think that he wants to depeg. I don't think that he wants to. I think he is trying to, like, if you go in the Maker Discord and you spend like a lot of time in the Maker Discord and you're on the forums, like there is a core group, the core group of people who hang out in there are very like, Maker needs to be self-sustaining. Maker can't have real world assets. Maker like cannot get censored. And so you have to appeal to that group. So what he did, I think what he just did in this thing earlier this week was very smart. He said for 3 years, basically we want to accumulate like max ETH, he called it. And we can do that by getting unlimited real world asset exposure. Then he said, we can keep the peg for 3 years, but we can go longer if there's no authoritarian threat. And then he said, we can delay the free float of collateral if we're at least 75% decentralized. He's putting in all these things that are like, yeah, we're going to free float, but like we won't free float if this. And like definitely the plan becomes censorship resistant, but like we don't need to if they're not coming after us. So like I don't think he wants, you never want to take the harder path. You, as a founder, like building a company is hard enough. Like you want to take the easier route. So like, I think he's trying to appeal to the core group of like basically employees who are, want something, but he's like, I don't know. I don't think he's actually, I think that he wants this to be, I think he wants real world assets. And I also think that he's smart enough to know that if you get a shit ton of real world assets, Maker is not like Tornado Cash. Like they censored Tornado Cash because like 30 or 40% of transactions were from like North Korea or some shit like that. Like if your collateral is from like Huntington Valley Bank, and then maybe in 2 years from like BlackRock, the regulators aren't coming after you. They're working with you. If BlackRock has put their stamp of approval on you. And I would assume Rune is smart enough to understand that.
So then this begs the question, where does the rest of OG DeFi go? Does it move in the direction of permissionless, or does it move more permissioned? Or do you have to kind of float between the two to get to this end state of maybe both?
It goes offshore with VPNs.
I think that
I don't know.
I think that's one possibility. I think like the broader thing that Maker is trying to figure out is like, what is its self-sustaining economic model? And unless you have that at scale with the product that you're currently offering, which like Maker, frankly, like it has some, but it doesn't have a ton of cash flow from just the interest rates they charge. You need something else. And like, that's basically what he's saying is like, we got this thing. It's like generating some cash, like not enough to cover everyone's expenses. And like, we also have this threat of like the US government nuking us. If we just got a bunch of ETH and we yield farmed with it and we like did all this stuff and like made the system more economically self-sustaining, because then we'd have assets we could earn yield on, like that's what makes a full business that really can't be taken down and can pay expenses every year. And, if you look at Maker, they're the most advantaged of the lending platforms because they have their own stablecoin. Their cost of capital is the lowest. They can give people loans at a moment's notice, unlike Aave or Compound, which actually needs to source the USDC and then lend it out. And so for me, this kind of begs the question to the other lending protocols. It's like, what are you guys going to do? And Aave is moving in this direction. They're issuing their own stablecoin. That'll lower their cost of capital. But like, is that enough to build a large self-sustaining business that can not only cover costs, but like produce a 10 or 20 or $30 billion market cap outcome, which is what the founders are shooting for? And so if I'm Aave, I'm thinking about, all right, do I need to staple something else onto my business model where I own the assets and I lend them out and I give that assets back to the Aave token holders? Compound, same thing. And so like, for me, this is like a very lending specific question around the business models. For things like derivatives and just, spot AMMs in general, I think it's more like derivatives, you only need like 30 large customers to make your exchange really work and profitable at scale. For AMMs, it's more of a question of like what your penetration rate is of the market. But Uniswap, if the fee switch was turned on, that token would be probably much larger. And so like, it's more of a question of the business models of these places than it is any like, to Yana's point, like, is this really about the US government trying to nuke them, or is this about their business model not being quite as attractive as people thought? And I think it might be the latter.
I have a question for you guys, based on like when we were looking at those relative valuations like Compound versus Aave. So Aave's done, relatively better than Compound over the course of the last, let's say 2 years. Do you attribute any percentage of that to Aave being based internationally and Rob living in the US?
Yeah.
Absolutely. I think, what this comes down to and what we're kind of implicitly saying here is your hands are somewhat tied if you're based in the US and working within the confines of regulation. You just can't move as fast. It's either an approval basis where you have to ask for permission to do a lot of different things, or you just know that things are going to be out of bounds if you're based in the US. Whereas in other jurisdictions, the rules are different. And that's just a fact of life. And, to Yana's point about this whole thing, DeFi moving out of the country and using VPNs, I think that that's one path. I think that there will be a lot of that. I also think that there will be a lot of DeFi that looks like public permission DeFi, where some of these things will move in the direction of regulation, whatever the time period is to enable that. I don't know. We, as Vance said earlier, we started engaging regulators basically in the last 12 months, but over the course of, let's say, years, which is the development cycle for a lot of these things, it will happen where you'll have, broker dealers that are on chain. You'll have, the ability to invoice factor accounts receivable in, non-DeFi, non-crypto invoices. Like that stuff will live on chain eventually. And so I think we're going to see two divergent paths. And that's kind of what Rune is getting at here, I think, is that he's basically calling like we're at the fork. I also agree. I don't think we're at the fork yet. It's not a binary right now. I think you're going to have some that move in one direction and others that move in the opposite direction. But you can also kind of live in both worlds still. And the window is definitely not closed.
I think I was being, I'll just say, like I said, it moves offshore, it's VPN. Like, I don't actually think all of it does that. I think, I really do think that hopefully the regulators and policymakers start to understand this stuff. And like the innovation, I'm hopeful, and capital and the founders can stay in the US. But I think a lot of it, that is why the regulation is important. So go ahead.
Yeah, no, you're going to be a father in 5 months. Would you advocate for your child to VPN in if he was a founder?
I was waiting for you to bring up some kid joke on this. I was like,
Ianna's getting married in 3 weeks. So we're all taking we're all taking over and unders on when the first kid is going to be here. I've got 5 months.
Reddit out here.
Next whole cycle.
My group chats. I muted every group chat because it's a kid joke.
All right, moving on. All right, moving on. All right, got one more thing that I want to get your guys' opinion on before we move on to memes, which is this Aave proposal, which is temporary ETH pause on ETH borrowing. So simple summary, again, we'll link this in the show notes, but it's a proposal to pause ETH borrowing in the period leading up to the ETH merge. In addition, basically ahead of the merge, Aave protocol faces the risk of high utilization in the ETH market. Temporarily pausing ETH borrowing will mitigate the risk of high utilization. So basically, when you have an enormous amount of people that want to borrow ETH, right, utilization goes up, and then there's difficulty in terms of managing collateral and liquidations. So I guess when I'm looking at this reading, I think it's like a very fair move, and it's an order of magnitude better, like that this is being done out in the open and people are voting on it. But I also do remember like when Robinhood kind of like changed the rules on everything, there was like this whole uproar of like, you guys are changing rules on things and everything like that. But maybe the difference is just that this is done in a super transparent way and, with good rationale. I don't know what you guys think.
I mean, obviously this is one of the core advantages of DeFi, the transparency, but isn't this just an ETH proof of work, thing? Isn't this just like a mitigation of people trying to borrow a bunch of ETH so they can have it on chain to be able to get the snapshot? I mean, that's my read on this, which I think is fair. And like, we should be pausing that. I also know that there are other protocols, at least Synthetics I know, as well as Coinbase, who are going to be pausing ETH and ERC20 transactions and movements ahead of a couple hours before and a couple hours after. I think that has to do more with like, let's just batten down the hatches and ride this merge out. But I think this one in particular, borrowing ETH, is a move against ETH-W.
Yeah, most likely. All right, guys. I know we're winding down here. Anyone have any suggestions for tweet of the week, meme of the week? Because I've got a couple.
And
we didn't talk about Saylor at all, actually. Yeah.
I was about to say we're missing one big topic.
Is that the lead into Saylor or Vitalik's?
Vitalik, obviously.
He's backing a weapon. What an L week for Bitcoin. We got Hero Saylor down, and ETH. What a win for ETH. But I mean, I don't really know what there is on the tax evasion thing. I mean, it seems like he wasn't paying the income tax in DC, even though he was supposedly living there. But he also had these videos being like, I'll never pay my taxes. Like, I'll fake a boating accident. Like,
cool.
Can't do that,
Let's see how that works. I mean, yeah, just like all of the super cyclers have been, basically taken out and shot. And it's not surprising to see that Saylor's not only been kind of like, I don't know if he was forced out of MicroStrategy, but like certainly his role has become diminished. And then this stuff, basically all those insane podcasts that he did over the past 2 years. Like, side note, my favorite Up Only episode is Michael Saylor talking to Kobe, because it's like Saylor interviewing Saylor on Saylor. It's like so like he's in his own head and crazy. And I think like when you say crazy stuff on podcasts, like, it's going to get around and it's not surprising. And juxtaposing that with like Vitalik and like how he's just like the best possible unelected leader of Ethereum that you could possibly ever get. Like one of our LPs who's super into the Grateful Dead thinks he's a lot like Jerry Garcia, where he's kind of like this guy who was this average dude and like not really ever wanted to lead, but was just chosen and placed atop a throne. And like, it's like he's walking through every day as if it was like his first day on the planet. It's like incredible, like great meme content. Obviously the picture from this week is like very demonstrative of like my last point, where like some things like just don't seem to register, but that's like the best part of it. You just know that he doesn't really have a mean bone in his body. And he's just uniquely well qualified for a number of reasons that, he has.
One of our founders who is not Vitalik, but I would say up there in terms of stature in a lot of ways, once asked me, and who is memed more than about any other founder we could possibly think of. He asked me one time, he goes, "Why am I such a meme?" And like to this day, it like still sticks in the back of my head. It's just like, do you think that, people who are getting memed actually know it and like think about it and react to it? Like, I wonder what Vitalik's reaction was to this week.
Because I remember the sharding episode when we were all making those jokes on Twitter and like being like, sharding. It's like, okay. And he was like, "I'm going to quit if you keep doing this." And one of the first tweets I saw after that picture got out was this guy named StateLayer who works at SudoSwap being like, "I'm not here for the Vitalik jokes. We're not making them this time. Like, if he leaves, I'm going to kill all of you." It's like, yes, protect Vitalik at all costs. That's very much my mindset at the moment. Whatever he says goes.
You could be accused of worse things, is what I will say for old Vitalik. All right, guys. Tweet of the week. Do you guys have any suggestions? Any thoughts? Play of the week, take of the week.
My first one was going to be what we just talked about.
Oh, I have
that
one
is
actually.
all time.
Let's see if I can find this one.
I've got one too. While you're finding that, right? I'm going to share my screen here. Actually, I'll just read it to you. This is the tweet. "White smoke has emerged from the chimney atop North Hollywood High School, signaling that Leonardo DiCaprio has chosen a new girlfriend."
Jesus Christ.
I was literally about to say the one that I liked was Kate Winslet versus old version of Kate Winslet, 25 versus 26.
That's really funny.
Right, this is my favorite.
Yes, I saw that one.
It's the guy sweating, but choosing between two buttons, right? And you're up on the bottom. I'm just telling. I know you guys can see it, but I'm telling folks who are listening. Starve but be woke. Turn on nuclear power plants. Can't make the decision between that.
Yeah, that was a little dark because that one's like playing out in real time.
I know, but it's real.
One that I liked,
yeah.
And this flew a little bit under the radar. I'm gonna put this in the chat so we can share it. Fubar, who's a great follow on Twitter. There's this guy Gabriel Layden who came from Machine Zone. He was the CEO. He's now starting in Web3. He's just been like terrorizing crypto Twitter all week. And
is this the Digidaiku guy?
And like, people have strong opinions about him. I'll kind of leave it at that. But I thought Fubar's tweet captured it perfectly, where he said, "It's been a while since we had a cult founder out for blood. This time is different. When you become the main character of crypto Twitter, there really is only one preordained outcome that we know of today. And that is basically, things get crazy at some point and you get nuked." And so it's crazy to see someone kind of step onto the scene, because a lot of the loudest voices in the room were like Sue and Kyle and Doe and people like that. And so, yeah, I mean, it appears that we have, a potential new, at least side character, maybe not main character. And hopefully this time is different.
Keep in mind, Machine Zone raised at $4.5 billion, I think, and then sold for $250 million. So,
did you guys invest in this company?
That's a loss for people
those
keeping track of the math at home.
Score.
I do not think this guy is a good new face of crypto Twitter. I'm just going to say that.
Well, he did just raise $200 million for marketing. Apparently.
Okay, I've got a question. Do you guys think if Elon Musk successfully rides off into the sunset, that he will flip this rule and that trolling people on Twitter actually will end in a good result? Like if Elon Musk flies off to Mars, being valued at $1 trillion personally, and was like, "Yep, I told the SEC to go suck Elon's, whatever." He just might, he might personally flip the rule of the universe, and then that behavior will be acceptable.
I think it's already acceptable.
The intergalactic SEC, though.
That's true.
I think it's already acceptable. Yeah. I was talking to a partner, one of the biggest, I would argue the top 5 crypto funds. They are now encouraging their founders to be louder and like more, as he described it, he said more doe-like on Twitter. He goes, we don't tell anyone to go full doe, but like we think it's a smart strategy to be a little louder. I was like,
yeah, it's smart to be a little louder. Telling people to be doe-like.
He said a little more doe-like.
So
there's better examples.
I would say, yeah, there's better examples, but having a loud founder is not a bad thing.
Who's your favorite founder right now? Like in your portco?
Better question.
Who's our favorite founder?
Yeah, and then if you have children,
who's your favorite children after that? who are 2 founders who have, I'll ask it in a PC way, like who have impressed you this year or something? I don't know. That's so much lamer.
I think the Kane comeback arc and like just, taking the beatings during the bear market or the bull market from Sue about like, the houses he bought and like turning synthetics around and like kind of telling the haters to go fuck themselves. That's been pretty impressive. I'm trying to think of who else. It's been pretty quiet on Twitter, as you would probably expect after the industry getting nuked.
How about Stardust? Stardust. That's okay. Canon is a gigabrain.
Cannon.
I don't know how to.
Cannon.
I don't know how to pronounce the guy's name, but I talked to him. I was like, you are a gigabrain. I like you.
That's a great new nickname. So Canaan was lesser known than Kane, for instance, but I think they have really come out, and Stardust is centralized, no token, so you're probably not going to hear about it as much. It's also infrastructure, so it's going to be underneath the surface. But I'd say Canaan would be my choice as well. The groundswell of talent that they have is growing.
There's also a lot of young bucks that are just getting started.
Yep.
So let those plants grow. We'll come back to those 6 months.
All right. Let's wrap.
I think finger guns is a good place to wrap it. So this was fun, fellas. We'll see you at the same time next week.
All right. Thanks
Cheers,
a lot, guys.
Take care.
See you guys.